Welcome to the Deep Dive. Today, we're tackling, well, a big one. Warren Buffett's planned move away from the CEO role at Berkshire Hathaway.
Right.
Now, this isn't just, standard business page news. It feels like a moment to really dig into the ideas, the fundamentals that powered his, well, truly astonishing success.
It really is.
We're looking beyond just the change at the top, seeing it as a chance to understand maybe the foundations of that kind of long-term achievement.
Exactly. And we've got some really insightful reflections here from an article looking back at his career, his legacy.
Yeah.
And like you said, the headline might be succession, but the real gold, I think, for you listening, is understanding the core principles behind it all.
Definitely. Our goal isn't, to turn you into the next Oracle of Omaha. I mean, that's a pretty high bar.
Yeah, just a bit.
Instead, we really want to pull out the key insights from his decades running things, the essential lessons that could be valuable whether you're managing investments or, frankly, just steering your own life and career.
Makes sense.
Okay, so where do we start? The numbers, I guess. The sheer scale of what he accomplished.
Absolutely. You almost have to start there with Buffett. The track record is just foundational. So get this. From 1965 all the way through to 2024, Berkshire Hathaway, it delivered an annualized growth of 19.9%.
19.9. Wow.
Now, to really get how remarkable that is compared to the S&P 500, over that exact same very long stretch, the S&P grew at 10.4% annually.
So nearly double the market return.
Pretty much.
Over 50 years.
Sustained for over half a century.
It's
just, staggering is the right word.
It really is. And the article we looked at, it really emphasizes just how rare that is, that kind of consistent outperformance.
Incredibly rare.
Most investors, right, whether they're just everyday folks or, seasoned pros, they actually end up underperforming the market index.
That's the standard outcome. Statistic.
You hear about legendary stock pickers, sure, but often there's that element of, well, they were in the right sector at the right time, maybe caught a wave.
Right. A bit of luck, maybe a hot streak.
But Buffett's record, even when you factor in his focus on value investing, buying good companies cheap, and the advantages Berkshire gets from insurance, even with all that, it still stands miles apart.
It does. The consistency is the truly unique part. It wasn't just one good decade.
So how did he build this? It wasn't, as you said, in a vacuum.
No, definitely not. And a huge part of it goes back to his mentor, Benjamin Graham.
Graham, the father of security analysis.
That's the one. Buffett studied under him, worked for him early on, and Graham really championed this idea of value investing.
Which is basically finding companies trading for less than they're really worth, right? Their intrinsic value.
Exactly. Looking for that margin of safety. Graham was very focused on the numbers, the balance sheet, finding those statistically cheap, maybe unloved companies. Cigar butts, as they call them sometimes.
Right, crunching the numbers. But here's what's interesting, and the article touches on this. Buffett didn't just, take Graham's playbook and stick to it rigidly.
No, not at all. That's a key point. Over 60-plus years running Berkshire, he took those core principles, yes, but he really expanded on them. He evolved.
Developed his own distinct approach.
A much more nuanced approach, and as those numbers show, an incredibly effective one. It wasn't static.
And he shared a lot of this thinking, didn't he, through those famous annual letters?
Oh, the letters, yes. The article rightly calls them artfully written and basically a must-read for any aspiring investor.
They really are something else. So different from the usual corporate jargon.
Totally different. Buffett has this knack for conveying what the article calls timeless Midwestern wisdom. It's just clear, straightforward talk about business, investing, life even.
And the honesty. That's what always struck me.
Yes. His transparency is incredible. He doesn't just gloss over mistakes. He dives into them, often in, painstaking detail, explaining what went wrong, what he learned.
Which is, well, it's basically unheard of on Wall Street, right? Where usually you trumpet the wins and quietly sweep the losses under the rug.
Precisely. That candor builds incredible trust, but it's also just rare.
And you see the impact, don't you? The article mentions how many other CEOs started writing their own annual letters, trying to copy that style.
They try, yeah. But as the saying goes,
the original is always the best. It really speaks to the authenticity behind it. It wasn't just a communication tactic for him.
No, you feel it comes from his core thinking. And speaking of his thinking, he always stressed that the key wasn't necessarily raw IQ.
Right. Temperament over IQ. That was his big thing.
Exactly. He believed it takes a certain kind of personality, a specific temperament, to be a great investor.
Which involves what exactly? Patience, certainly.
Patience, definitely. The willingness to do the often tedious work, as the article puts it, of really digging into investments, researching thoroughly, and then having the courage to act. Being decisive when you've done that homework and you see an opportunity, even if the market is, going crazy the other way.
That really highlights his skill beyond just picking stocks, right? It's about capital allocation.
Huge. He's not just a stock picker. He's deciding where Berkshire's massive amounts of capital should go. Big picture decisions.
And the article points out he wasn't afraid to just sit on cash, sometimes huge amounts of it, if he didn't see anything compelling.
Right, resisting the pressure to always be invested, but also being brave enough to dive in during a crisis.
Like 2008, that's the classic example.
Absolutely. When everyone else was panicking, he was making deals, providing stability, and yes, getting very good terms because he had the capital and the nerve.
That courage, that decisiveness, it links back to temperament, doesn't it?
It all ties together. But it also ties into another crucial point: adaptability, learning. He wasn't afraid to change his mind or evolve his approach.
And Charlie Munger looms large here, his longtime partner.
Oh, absolutely critical. Munger's influence was huge. The article highlights how Munger really persuaded Buffett to look beyond just those super cheap Graham-style cigar butt stocks.
Pushed him towards quality.
Exactly.
Yeah.
Munger convinced him to consider the quality of the business, its competitive advantages, its management, its long-term prospects, even if it meant paying a, somewhat higher price than strict value metrics might suggest.
So not just cheap, but good and reasonably priced?
Precisely. This sort of blend of value and quality became their hallmark. And as the article notes, it was incredibly powerful and became a strategy many others tried to imitate.
You can see that shift in Berkshire's bigger buys later on, right? Buying whole companies with strong franchises.
Definitely. It shows that evolution, that willingness to learn and adapt, even when you're already incredibly successful, which is a lesson in itself.
And speaking of lessons, the article also mentions dealing with setbacks. It wasn't all smooth sailing.
No, not at all. People forget that. Many professional money managers live in fear of a down year. It can be career-ending.
But Buffett,
he had 11 of them, including some really significant drops early in his career. His view seemed to be, downturns happen. They're part of investing.
not something to panic about.
Not something to fear fundamentally, but something to navigate. Maybe even see as an opportunity if prices become attractive again. It's that long-term perspective.
Now, as he got bigger, richer, more famous, that must have created opportunities too, right? Like that Goldman Sachs deal in '08 you mentioned.
For sure. His reputation and Berkshire's sheer size opened doors. He could negotiate terms others couldn't dream of, like that 10% dividend from Goldman. He became a sort of financial backstop in crises.
So, advantages of scale.
Definitely. But the article brings up the other side of that coin, the challenges of scale.
Meaning?
Well, as Berkshire's capital base just got enormous, finding investments large enough to actually move the needle became harder and harder.
Yeah, $1 billion gain doesn't impact the percentage return as much when you're managing hundreds of billions.
Exactly. Especially during a long bull market when bargains are scarce anyway. This law of large numbers probably contributed to why outperforming the market became tougher in more recent years.
That makes sense. It's a victim of its own success, in a way.
Sort of, yeah. A high-class problem, but a real challenge nonetheless.
But maybe one of the most remarkable things, something the article really highlights, is where he did all this from.
Omaha, Nebraska.
Yeah. Not Wall Street, not London or Hong Kong. Omaha.
It completely debunks that myth, that you have to be in the thick of the financial centers to succeed big.
He seemed to prefer being away from the noise, didn't he?
He often talked about the value of having a quiet space, time to just sit and read and think, without the constant chatter and pressure of Wall Street.
And his whole approach to the businesses he bought seems different too.
Very different. He liked buying companies run by, as the article says, good, honest, and hardworking people.
And then he let them run it, right? A pretty hands-off approach.
Largely, yes. He empowered the existing management. And he wasn't just hands-off. He seemed genuinely enthusiastic about their success, publicly praising them.
It suggests a different kind of leadership, focused on trust and integrity, not just the bottom line.
Absolutely. Which kind of brings us full circle back to the underlying philosophy. There's a quote mentioned from an annual meeting, I think.
Oh, yeah.
He said something like, "Be kind and the world is better off. I'm not sure that the world will be better off if I'm richer."
Wow. That's pretty profound, especially coming from one of the richest people ever.
Right. And the article's conclusion really leans into this, suggesting his greatness wasn't despite this kind of philosophy, but maybe because of it.
That the values were integral to the success, not separate from it.
That's the implication. A set of values reaching beyond just making money.
So wrapping this up, as we look back at Buffett's career, prompted by this transition, the big takeaway isn't just the incredible financial returns.
Well, it's deeper than that. It's about this consistent philosophy, right? Grounded in constant learning, that crucial temperament, patience.
And that focus on value and quality, both in companies and, it seems, in people.
Exactly.
And for you listening, while maybe achieving Buffett's scale is, unlikely.
Understatement of the year.
The principles he lived by, they offer really valuable lessons, don't they? For making thoughtful, long-term decisions, pursuing goals, really in any field.
Absolutely. It's much broader than just finance.
Which leads to maybe a final thought, something for you to chew on. Given how much Buffett emphasized temperament, learning, adapting, these sort of non-financial qualities, what seemingly non-financial qualities might actually be the most significant drivers of success in your own life, your own work. Maybe reflecting on those philosophical bits, as Buffett did, could be where the real insights are.
That's a great question to end on. Really makes you think.